So for this one, before we begin with this one actually, so this is the more detailed explanation of HODLR, because this is for also those people who are looking at the code, so they will be able to understand the code from this explanation. So which is why I'm making this video. But apart from that, let's go through what we have already gone through, in which I have made quite a few videos on HODLR right now, in which I have explained like a very basic intro to what HODLR is in the first video. In the second one, I explained whether it's an algorithm or a trading bot or an application, and quite honestly, it's a combination of all of those things. So which is why I keep interchanging the term application or algorithm, and I've like essentially called it the HODLR algo. So it is definitely the algorithm that I've written, so which is why I'm calling it the algo, and I've explained it in the previous videos that why. Then I did a video on basic trading concepts, that what it is and how are we applying it in HODLR. Then I did a TLDR, which is not this version, which is a very compressed version, or rather an easy to understand version of what it is. The collateral and liquidity was discussed in another video, in which I've explained that how are we getting the collateral, liquidity and everything. So then the last to last video, I explained about the fact that HODLR is a stability algorithm, that it stabilizes investments, and I've explained that how it does that. So this is a very important video that I think everybody should watch even before this one. And in the last video, I discussed the test results of when I was running it between the 6th and the 11th of November. So the results are pretty, I mean, like expected, because I was running it before this also. So before this also, I was running it for approximately 10 days. So I knew that the kind of results that it would provide, because there was no other changes that I did to it at that point of time. So I ran it again, and it gave me pretty much similar results. And I'd encourage everyone to watch it before watching this video, because that will give you a better basis on which this video is made. So I'll just remove this part, since all of these things have been covered right now. I'll just remove all that clutter so that you can understand this concept well, because this concept is essentially about this is how I actually wrote the code. So when I was writing the code, just before that, I actually made a sort of a pencil sketch of these graphs, and that is how I actually broke it down. And then I wrote the code, then I wrote the algorithm, and there were a few more things that I'll discuss in the future videos that helped me write the algorithm, like the technical concepts which actually helped me at that point of time, which and the ones which I researched for quite a bit of time before I wrote it for the final version, which I talked about in the last video also, that there were two versions. So the one that you're looking at right now is the final version, which I'm gonna like improve right now. So it's like when you're writing something like this, at that point of time, you could have multiple versions of the same thing, because you would not know the one which works the best. So you should not restrict yourself to just like one thing and give up on what you are working on. You should like continually improve the algorithm and keep working at it, or like just scrap the previous idea and then work on a new one. That's how you do it. So, and that's how I came up on this, because I was trying to emulate human behavior, or rather the behavior of a trader, like how a trader actually trades in the market. So this is something that I wanted to discuss in this video, that whatever you're gonna learn after this is essentially something that a trader does normally in usual circumstances while trading. And this is how we actually observe the charts, the graphs and everything, and mostly break it down in our brains, because there is a human decision making which is involved. And since we are human beings, we look at it in a singular point of view, which can be broken down into an algorithm, which this algorithm is. This essentially I wrote it from like understanding what I do generally when I am looking at a chart. So, and this is what people generally do all the time. So it was pretty, so any algorithm in the world essentially written by observing nature, like what you see around you, the way that people do things. So that we break those things down, and that is what we generally learn in college also, that when we are studying algorithms, that's what they teach us, that they take real world examples and they teach us that what would you do in this situation and how would you automate this thing that is happening repetitively. So the market also works like this. It is a repetitive pattern, which is why you would have a lot of traders analyzing those charts and mostly being correct also, because it's a repetitive pattern which is happening continuously and in cycles. So just like the Bitcoin cycle that most people know about. So generally the market does work in cycles, and which is why we can write an algorithm based on it, based on the patterns which are happening. And this algorithm is also that, and it is no magic or anything like that. It is essentially observing what happens in the market and then emulating human behavior of traders, that how do traders actually trade when they are observing the market. So this is what it is. There is no mumbo jumbo involved in it apart from that. So this is one thing. There is one thing that I did want to talk about, that this did go for a vote in Prop 11859 that I was talking about for quite some time. And but the vote did not pass, and there is no like particular issue about that, because I did not like write it before a vote also, or rather for a vote also, and I did not write it because and I did not wait for a vote to actually continue working on this. So there is no relationship that this has with a vote on governance, because the work does not involve making changes to a blockchain. So I do not need to like upload a proposal to make this thing work essentially. So I can make it work irrespective of that. But yeah, I can like create a whitelist proposal maybe later, in which the burn taxes will be exempted from this application, because anyway we'll be burning. So, and we'll be burning a lot. So which is why like I don't think that will be required also, because it is similar to Binance's application. Like how Binance does the burn, we'll be doing maybe similar burns. But obviously that will depend upon like the volume, but I can talk in percentages when I'm talking. So yeah, I mean that is one thing. And the second thing is that this will definitely go live after this. So I am gonna create an application based on this, or rather I'll take this and then I'll make an application on it. And so because I've already written the algorithm, but I have not written a UI or a middleware to handle the calls with the UI. Those things are things that I'll have to do after this. So it'll take probably a little bit of time, but I'll try to wrap it up as fast as possible, so that we can have a working GUI in which we can observe that how the algorithm is working, especially for non-technical people, because they won't be looking at the code and the database to check that how it is working exactly. So for those people it will be really beneficial. Now getting to the concept that how is it working in the code. So this is one of the primary charts that you will need to understand to get that. And I'll explain what is happening over here, which is very simple actually. Nothing is happening over here apart from the prices going up, then going down, and then going up again. That is pretty much it. And this could be like any currency. Like I explained in the last video that this could even be not a crypto and a stock or a commodity or something else also. So in this example, let's consider that this is LUNC and not USTC. because I want to explain it from the point of view of a different currency, and you'll be able to understand that there is actually no difference in the way that any one of them function. So let's just consider that this is lung. Okay, the price is essentially going up from 1, which is the first starting point of this algorithm, and it is going to 2. Then there is a third point over here which I'll explain. Then it is going to 4, which is going down again. So at point 5 it is at the bottom. So this is the lowest point of price that it can be according to our example, and then it's going up again. So 6. So when it does go up again, the same thing happens. So you can consider that this is actually 6. So it essentially it's like a cycle. So this repeats in a way. So this goes back to over here, and then this is gonna happen again. So which is why it's an algorithm, because I am also like processing it like that it is a cycle which is continuously happening, like the price is going up, then it is going down again, and then it is going up again, and when it goes up again, it then restarts the entire thing. So this is something that you need to understand, and that is how the code also has been written, which is why I could write it in components, because it wouldn't matter how I'm writing it, because essentially it's doing the same thing. So now coming to the question that what is exactly happening over here. So let's break it down into smaller charts. Okay, so which is what I've done over here, that I've broken it down into smaller charts, these two from this. Okay, just to explain points 1, 2 and 3. So this is what I want to explain right now. And so this is, in my system, this is called a long, and this is so this part of it from 1 to 2 to 3. So 1 to 2 to 3 is essentially called a long in the system. And the parts which I'm showing you right now, which is this part and this part, I mean these two parts. So the first one which I'll show you is just the price going up, which is called long above price in the system, I mean in the code. So when you're looking at the code, you'll be able to see that I've written a function called long above price. So this is what that function is. And then I've written a function called long below price. So in the code, you'll be able to see that when you see the code, that there is a function called long above price and long below price. So these are the two functions that I'll explain first. So the long above price is very simple. It is essentially, here is the starting point of lung. So say lung is at 0.00008, like how it is right now. So this is the starting point. This is from where the algorithm begins. Now in the algorithm, I always consider that that it is a long and not a short. Okay, even if the price is going down. And this is a consideration that I make in the algorithm because of a very simple reason, that the algorithm begins with lung and not USDT or a stable coin. So it begins by investing a non-stable asset which we are trying to stabilize or rather convert into USDT at intermittent points of time to stabilize the investments. This is what is actually happening in the algorithm. So when it begins from 1, it has to be a long and it cannot be a short, because the investment is already in lung and not USDT, which we are converting to, and what actually starts the process of a short. So unless the investment is in the form of USDT, I cannot actually start a short, and I will always have to do a long. So this is a very simple concept that you'll understand if you do margin trading or futures or whatever it is, because that's how it works. Because in margin trading, you would always short if your investment is already in the form of a stable coin and you are trying to get as much of supply as possible, okay, or rather as much of volume as possible for as least as possible. That is what a short process is. And in the long process, you're trying to get more volume or rather more whatever investment at lesser, I mean you're trying to sell your investment which is already in the form of lung to a price which is higher than you bought it at. So this is what a long process is. So which is why this begins from here and it goes to a point which is at a higher price. So say this is 0.0001. So this is, I don't know where you can see that. Okay, let's move it here. Yeah. So say this price point is over here at 0.001. So this is what we are trying to achieve in the first function, that we are trying to check that whether the price from which the original investment has begun has actually gone to this price. And we are not doing anything, okay, at the first function. We are essentially just checking whether it has gone to this point of time this price point or not. That is all that we are doing. And this is what I'm calling a long above price, because this is the original price and this is above the original price, which is why the function is called that. And this is all that we are doing over here. And now you'll understand that why am I doing this? I am doing this so that I can come to this function. Okay, it works like a chain. So you'll have to go from one function to the other function to the other function, but you can also jump from one function to the third function. And there is no actual way in which you need these things to happen serially. It doesn't really matter. It can happen like at the same time, before, after, and it wouldn't really matter, because in the cycle of things, in the larger picture of things, like you can see over here in this graph, it wouldn't really matter, because this is as you can see, it's like a double helix. So it just keeps happening in a loop. So this is like a perfect representation of a loop actually. So it wouldn't really matter at which point of time you began, whether you began from the point, point 2 over here, or whether you began this loop from point 5 over here, you would still go like this. So it doesn't really matter. It doesn't happen serially. You can even do it in the reverse direction and it would still work, because there is no actual way in which this needs to work or the market really works. So it always keeps happening in a cycle, whether or not in the same direction. So now we come to the second function which I have written in the code, which is called long below price. So over here, what we are doing is something that you'll understand if that I'll explain. But before that, let's get to a very simple concept of that how do traders actually trade. So traders trade by essentially observing continuously that how higher the prices are going, so that I can sell at that point. So if say the price is at like 0.008, now I'm continuously checking in whether I'm doing spot trading or I'm doing margin trading. I'm continuously checking whether it has gone to this point or not, the higher point. So I'm at all points of time, I am checking where's the top. So this is a very basic concept of trading, that I'm continuously checking that where the top of the investment is, so that I can exit from that position. The point is not to hold it continuously like Bitcoin. Bitcoin is something else. It's like more like a store of value. Like if you hold it for like the next 5 or 10 years, it'll probably increase, and that is the most chances of happening, because that is what has happened till now. But Lunk or some other coin is not like that. Over there, what we got to do to protect our investments is that we got to continually check that where is the top, so that I can exit from that position and I can buy back a larger volume or a larger investment at lesser price. That is the entire idea. And that is what we are checking over here, that where the top is. So number 2 is essentially the top. So this is what we'll check over here. And how do you know? How do you know that what is the top? You actually don't. So this is a very weird concept, that in trading, that you don't really know that where the top is. So what you do essentially is that since you don't know where the top is, you try to observe that what is the point at which the price begins to fall. Okay, So from this point number 2, which is the imaginary or the theoretical top, okay, it is the top of the price, theoretical, but you don't know what that is. This is a question mark when the algorithm begins. So the way that the algorithm knows that what the top is and when to actually exit is by checking when the bottom of the top is. So this is actually the bottom of the top. Now how do you know that what the bottom of the top is? Okay, so you know that by tracking from this point, from the second point till the third point, that how much the price is reducing, and you would exit. Generally this is what we do in margin trading. You would exit at something like 1 to 2% of that price when it goes down from the top. So when we are margin trading, we can continually see that how much profits or losses we are making. So when we see that we have made a lot of profits, we keep observing from that point, that from till that point that it goes down 1 or 2% in margin trading. That means that you have gone down your profits by 10 to 20%, because if you're doing a 10x, then your profits that is actually reducing is by 10 to 20%, which is a lot, and which is the reason that I'm not doing margin trading over here, because that will make a lot of losses for the customer for no reason at all, and you might actually get liquidated in that position. So which is why I'm doing spot trading, and which is what I've explained in the previous videos. But anyway, this is how we get to know that where the bottom of the top is, which is by observing that when it has gone about 1 to 2% below this top price, you gotta exit. So what does exiting in our system mean? In our system, exiting essentially means converting from, say, USTC or LUNC or whatever the non-stable asset is to USDT, which is the stable asset. So this is what exiting in our system means, or rather we are just swapping. So we are just swapping from a non-stable asset to a stable asset. We just let a non-stable asset reach the top naturally, like how the market wants it to behave, and we just naturally let it fall for some time, for 1 to 2%. And when we do that, at that point of time, we swap it, because we know that this price is actually reducing. And you know perfectly well that if it has reduced by 1 to 2%, then it is gonna probably reduce further, and that is maybe it will reduce by just 1%. Okay, but even that reduction of 1% at a 100x margin is essentially 100%. So which is a lot of loss, and you would not want to make those losses. So which is why we need to exit and conserve these profits, so that we can keep protecting our investments, and that creates a buffer. It creates a buffer. So when you exit from here and you started out from here, say from here to here, it was about 5%. So the gain over here is about 5%. Now this 5% reduced by 1%, and you swapped back to USDT. So what would happen is that you actually kept back 4% profits. This is the logic of the system, how it is actually working. So you keep observing where is the top, and then when you see that there is a bottom of the top, you actually swap to USDT. And this is the part 1 of the system, in which there is a part 2, but just absorb what I've said in the part 1, because then I'll make another video on the part 2, because I'll explain a little bit more. But I think you would have understood that how we are starting the algorithmic process, because this is a loop which I have actually emulated into human behavior of traders, in which traders continually observe that how much are we going up in profit. Say I have gone up by 5%, and then we traders observe that whether it has gone down by 1 to 2%, and that is when we exit. So this is the entire idea. and a lot more detailed explanation of how it is working. So I'll keep it at this and I'll explain the short version, when I'm doing the short above price and short below price, because a little bit more complicated. So I'll explain it in a separate video.